Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and we're going to talk about climate change and macroeconomic consequences of climate change, and we'll bring in a few of our other colleagues to talk about that. But before we do that, I want to bring in my two co-hosts, Marisa DiNatale. Hi, Marisa. How are you?
Hey, Mark. I'm good. How are you?
Good. You're hailing from Southern California today?
I am. Yep.
Excellent.
Made it back from hurricane-addled Florida last week.
I know. Did you know my home in Florida, the eye of that storm went right over my home?
Really?
Wow. And the only damage I had, bizarrely, was the screen. One screen got broken. That was it.
Wow.
Really bizarre. Even the beach, was impacted, but very modestly. Most of the impact was kind of north, towards Daytona Beach.
Yeah.
That beach got creamed, unfortunately. And where were you? You were in Naples, I think.
I was in Southwest Florida.
Southwest.
So last week when that hurricane was hitting the East Coast, my flight got canceled. So I didn't make it back the night that I wanted to. And then the next day, I spent the whole day in the airport trying to get home. And I did.
Nice airport, though.
It is. If you have to be stuck in an airport, I guess
that's the Fort Myers airport, I believe, right? Yeah, not a bad airport. Yeah, very manageable. And we got Cris DeRees. Cris is the deputy chief economist. Hey, Cris.
Hey, Mark.
I see you have your glasses, the infamous infrared. What are those?
Blue blockers.
Infrared.
Yeah, infrared. Can't you see through things with those glasses?
I can see recession.
I see recession. Dead ahead.
Yikes.
Dead ahead. Let's just get this over. Let's pull the Band-Aid off. So what's the probability of recession between now and the end of 23? You were 67% last we chatted. Is it what are you?
Oh, it's up. Yeah, unfortunately.
What?
I'm feeling even more confident in the unfortunately.
So bizarre. I feel. Oh, really? So what is the what's your probability?
I'm going back up to 70, maybe 72%. That's
wow.
Out of 5. Yeah.
Okay, what changed between this week and last week? From 67, you were at 70 last week. You went to 67, and now you're back up to 72. So what happened?
A lot happened. Well, just look at the yield curve, Mark. It's inverted the whole way through.
Okay, I'm highly annoyed at this conversation. All right. Let's talk about this yield curve. Which yield curve are you looking at, by the way? All of them, or
all of them?
All of them. Fed funds to 10-year, 3 months, 1 month.
That's barely inverted, and that's just bond market goes up and down all around on a daily basis. But here, let me
10-year, 2-year, right?
Let me ask you this. Okay, let me ask you this. Let's have a serious conversation about this.
I'm always serious.
Oh, I know you are. It's Marisa who's always cutting jokes and off the rails.
Somebody has to bring a little levity to the conversation.
Exactly. That's exactly true. We have to have a little bit of levity. You notice I every night my wife and I watch an hour of TV, and TV is actually pretty good these days. If you've got all these streaming services. And the one thing I've learned is if the TV series or show has no levity, it's all dark all the time. Very hard to watch that. You need, right? You need some levity in there. And thank God we have Marisa on for levity. But Cris,
Marisa's a yield curve believer, I believe, right?
Is she?
Proselytizer?
I wouldn't call myself a proselytizer, but yeah, I mean, it's not ever been wrong, right? It's sort of hard to agree with that.
It depends, over what period of time, false positives, so forth and so on. But let me ask you. Let's start this conversation this way. And I should say there is some economic data that came out in the week.
Yes,
mostly housing related. So we can come back to that and talk a little bit about that. But before we get there, let's talk about the yield curve. So if you're a listener, a regular listener, you've heard this conversation about the yield curve a lot.
Ad nauseum.
Yeah. But, just to level set, Cris, so tell the listener why the yield curve, what is the yield curve, why an inversion of the curve is historically a prescient leading indicator of recession.
So at its core, it's just the yield curve is just the difference between different rates, or different treasury yields, I should say. So typically we'll look at the yield on a 10-year versus a 2-year treasury, or a 3-month treasury, or a 1 month, right? So you can pick different points along that curve and make comparisons. In a normal, well-functioning economy, that yield curve should be upward sloping, meaning that for the longer term that you are willing to lend the government money, you should expect a higher return or demand a higher yield. All right, and that's in a well-functioning economy. When investors are nervous about the future, you can see inversions in the yield curve where the shorter term yields suddenly rise above the longer term, right? So that's what we're talking about here. Today, the 2-year is about 70 basis points above
Yeah,
the
I think it's 70.
10-year.
Yeah.
I think the 3-month is maybe 50 basis points. So it's by historical standards deeply inverted at this point, at least for those portions.
Measures. Yeah.
Measure, correct. I think you have to go back to 1982 to get this type of inversion that we're seeing here today. Why that matters? Well, so this is a bit of
just a caveat there. The one curve that isn't that inverted, just on the margin and for the last few days, is the 10-year Treasury yield versus the federal funds rate, the effective federal funds rate, the so-called policy yield curve, because
correct.
The Fed sets the funds rate. And I looked today, I think we're at -4 basis points or something. And it's been the last few days because the bond market has rallied in the last few days. Since the CPI report was so good last week, the bond market has rallied, meaning long-term interest rates have declined. All rates have declined, but long rates have declined more. And so you have this now inversion by about 4 basis points. So historically, the policy yield curve, it has led recessions, but it also has had false positives. So you've had inversions where the funds rate rises above the 10-year yield and a recession not ensued. So,
right.
But anyway, just to round that out. So why is it such a good indicator of recession down the road?
So I think just to clarify there, I think the 10-2 and the 10-3 yield curves, particularly for this level of inversion, have always properly signaled recession. I don't think we've had any false positive for those.
Yeah, I think that's at least since I don't know how many recessions you've gone back, but at least in recent decades, let's say back to the 1970 recession, I think 69 recession.
Yeah,
was it 69 or 70? Yeah.
Okay. So why is it oppression? Well, one, I think you hit the nail on the head in terms of just the bond markets. These are one way that investors speculate or put their money where their mouth is through these yields. So if you are expecting a recession, you might pile into a longer dated asset because you just want to, protect your capital versus equities where you might expect that lower profitability is going to erode stock prices. So you might be betting through the bond market. In terms of the real economy, though, we believe it's really through the banking system, right? Particularly hard to earn a spread when the yield curve is inverted. If you're a bank, lending out money long and borrowing short, right? And under that inversion, it's difficult to earn a spread. So in that environment, you would expect that credit would dry up. Banks would pull back on the credit they offer to either businesses or households. And as a result, you have a slowdown in the economy, spending goes down, and we have a recession. So it's a signaling mechanism from that point as well.
Okay, so really two different explanations as to why the yield curve might be a good leading indicator of recession. The first is it's the collective wisdom of bond investors. And the collective wisdom is saying we're going to have a slower growing economy in the future, recession. That means less inflation. That means a long-term bond is worth more. I'm going to buy that bond. And that sends down long-term interest rates. Of course, short-term rates are kind of pinned high because they're pegged off of what the Federal Reserve is doing in the funds rate. So if the Fed has got its foot on its brakes and has the funds rate high, that's pushing up short-term interest rates, and they can't come in as much, and you get this kind of inversion. Mm-hmm. So it's kind of the forecast, a consensus forecast being done by bond investors.
Correct.
That's the first explanation.
That's the theory. Right?
I admittedly am out of the consensus. I admit that. On my forecast, although I do acknowledge the recession risks are awfully high and it's a close call, but I think my forecast is just as good as the average bond investor's forecast, and it's different. I have a different forecast. Second explanation. So I'm kind of
You're
discounting
entitled.
that one.
You're
I don't.
entitled, Mark.
Who cares? I mean,
But
except
but so then why has it always been correct? If you
Yeah,
look at the 10-2.
okay. So that gets to the second explanation. Something more fundamental, right? It has to be. There's got to be some reason why the yield curve is contributing to the prospects for recession. Some causal relationship between them. Not just forecasts or forecasts. And that goes, I think you're right. I mean, that is the most logical kind of way to connect the dots fundamentally between the yield curve and the economy. Has to run through the financial system. And it's, credit, the way I would kind of phrase it is credit is the mother's milk of economic activity. And too much credit, that's a problem. That's the financial crisis. You extended out too many mortgage loans that poor underwriting, they blew up. Not enough credit is a problem. It's called the credit crunch. Businesses and households need credit to do what they do: buy cars, buy homes, expand businesses, that kind of thing. So when the yield curve inverts and the cost of short-term money, the cost of funds for lenders rises relative to the rate that they can extend that credit out, that so-called net interest margin you mentioned, they can't make money, so they're going to be less likely to extend credit. And historically, that slows economic growth and ultimately leads to recession. Let me, though, proffer that maybe, and I know everyone's going to cringe when I say this, but let me just proffer
don't say it.
I'm
Not
going to
those-
say it. I'm going to say it. You know
Not the
what I'm
four
going to
words.
say.
Not
Marisa,
the
you know what?
four
Yeah,
words.
this
What is he
time
gonna say?
is different. I'm going to say it. Maybe, well, we're going to find out, but maybe. Let me throw out a couple, three reasons why this might be different. This time might be different, and hear what you have to say. The one reason why this time may be different, and this is, you've heard this many times, but let me throw it out there and see how you react, is QE. The Federal Reserve, has bought a lot of Treasury bonds and other mortgage-backed securities, and they're now QTing, allowing that to come back down. But it's really about the amount of Treasury and MBS mortgage-backed securities that they own, and it's close to, what is it? Close to $9 trillion.
Right.
It's quite substantive, and they increased that dramatically during the pandemic, on top of increasing it dramatically during the financial crisis. And of course, they did this. The Fed did this because short-term rates got to the zero lower bound. They couldn't lower short rates any further. They didn't want to go negative. They said, okay, let's get long-term rates down, so let's go buy long-term bonds. So they bought a lot of long-term bonds and brought down interest rates. And so, the 10-year Treasury yield is affected to some degree by that QE. Now, debatable how much, but it could be 70 basis points. I'm just saying, it might be. It might be 70
Wouldn't
basis
that be
points.
convenient?
Wouldn't that be convenient? I'm just saying. Okay, so I'll stop. That's one thought. How do you respond to that? This time is different in that. I mean, it is somewhat different, right? I mean, the Fed QE'd beginning in the financial crisis, and obviously QE'd big time in the pandemic. That is kind of sort of different than other business cycles when the Fed did not QE, for sure, right? That they never got to that point.
Yeah. So when they were actively QEing, right, and then they were manipulating, or certainly.
Oh, that's a loaded word.
Well, I didn't. I took it right back, right?
That's just straight up monetary policy from. Okay, you took it back. Okay,
I took it back quickly. They
Okay.
certainly were affecting the law.
Yeah.
as well as the
Yeah,
Fed,
absolutely.
right. So that's not,
Yeah.
nothing nefarious, perhaps, but when they were actively involved during the pandemic and during the Great Recession, you would say, I think it is legitimate to say, oh, well, yield curve effects may be distorted here. We're not getting a true market signal, right? And you're right. Today, it is different. They are holding a lot of securities, but they're not actively dumping those securities or buying more security, right? So I find it hard to believe that we're not getting at least some signal from investors out there.
Oh, no. I'm not saying there's no signal, but this goes to the stock flow explanation of QE. I mean, I think the evidence at least the academic research, the Fed research shows that it's about the stock, meaning how much they hold, the dollar amount they hold on the balance sheet, not the flow that matters in terms of the level of interest rates. So, 9 trillion, yes, the 9 trillion is starting to come down because of QT, quantitative tightening. They're allowing the treasuries that they own to and MBS to roll off the balance sheet through maturity, or in the case of MBS, if there is any prepayment, I don't know, but if there was, they'd roll it that way. But it's really about the stock. So, I mean, that's debatable, but
possible. But how
okay,
much, right?
all right, okay.
Possible, but how much? We're
So
talking
you
20
would
basis
say
points,
maybe
30. I mean,
okay.
again, we're very.
I'm just saying. It could be 70 basis points. I'm just saying. All right. Here's another thought. And this one you probably I've not heard this. This is a Zandy thought. I think the reason why an inversion of the curve has such a big impact on credit and ultimately on the economy is it comes historically generally after a period of very rapid credit growth. The economy's booming, credit growth is very strong, underwriting is weakening, and people are taking on a lot of debt. Leverage is increasing both on the household and corporate sector. And then the Fed says, oh my gosh, they step on the brakes, the short-term rates rise, and you get that inversion of the curve, and credit flows stop. Businesses, banks say, I can't make money. Financial institutions can't make money. Their net interest margin goes flat or inverts, and they can't make money, and they stop sending credit. And that's a problem after the period of very rapid credit growth, because all these folks, businesses, households that took on the credit, they need to roll that over. In many cases, particularly businesses, these are short-term loans. They could be a year, 3, 5 years, but they roll over. And when they roll over, they need credit. But here, all of a sudden, the curve is inverted. Banks can't make money. No net interest margin. No. They tighten up underwriting, and that business or that household can't get the credit that they need, and that results in a default and delinquency. And that's why you have an economic problem, why you have a recession, why it leads to recession, why it leads to stress, why businesses lay off workers, in part because of the financial stress that they face. That is very different than the environment leading up to this period. Credit growth was not booming. In fact, it was very modest, kind of credit growth. And it's not like, there is going to be businesses and households that need credit in the current environment when underwriting is tight, but it's not a wave of borrowers that need it. Therefore, we're not going to see the kind of defaults and delinquencies and credit problems that we normally see that ultimately cause businesses to pull back, households to pull back, lenders to pull back, and we go into recession. Okay, what do you think of that explanation?
So
this time is different. This time is different in that regard.
Did you want to say something, Marisa?
Well, so what period are you going back to? Because the curve inverted right before the pandemic too, right?
Yeah, well, that was the.
So are you including that whole? Are you going back to before the pandemic, like credit
I'm taking
from the financial crisis up?
Yeah. I'm going back to 1970. To every recession since 1970. Cris is pointing out, and he's right, that when the 2-year and the 10-year invert, you have a recession within 12 to 18 months after that, including the pandemic.
No, I understand that. I'm saying your argument about credit growth hasn't been that strong recently. What period are you talking about? Are you talking about the past couple of years? Are you going back
in the lead up to this? Yeah, in the lead up. You hear my logic. I'm saying the problem the curve is creating. So you had all this credit growth before the curve inverted. Go back prior to that. And I'm saying this time is different in that regard compared to those previous cycles.
Sure. Certainly that was true leading up to the financial crisis and
every other one.
And
if you go back.
And 90s.
Yeah. So I agree with that. Certainly businesses and households are much more flush with cash today than they were previously. Actually, this is part of the reason why I actually upped my odds in terms of recession risk, because my fear is that you have the higher income households and businesses may be less sensitive to interest rate increases in this environment because they already had, to your point, they have a lot of resources, and therefore the Fed will have to overshoot even more to get the type of sensitivity.
Yeah, but
It's
okay,
gonna slow
that's
things
that's a smokescreen compared.
No, but that's
this
the
argument.
That's the
No, we're
mechanism.
discussing the yield curve, right? And the yield curve reflects what the market thinks the Fed's going to do. They're not that.
That's right.
So the collective wisdom has embodied exactly what you just said, right? So going back to the curve and the predictive ability of the curve.
But that's consistent, right? I believe the markets are also anticipating that the Fed will have to be even more aggressive than what we originally thought, because we're not getting the responses from households that we otherwise. Right, we're having retail sales this week, continuing to remain quite strong. Right, that's not the response that the Fed certainly wanted. Right, they want things to
Well,
slow
I
down.
don't. No. I'm not sure. I mean, if I were them, that's exactly what I would want. I'd want things to slow. I mean, real
Trying to get
retail
it
sales
slow. It was well above consensus, right?
Well, I don't care about consensus. I've got real growth. Real growth. Consensus is what do I think is going to be, not what it should be. Yeah, it's what it is, not
Fed
what
expectations. Let's put it.
Yeah, I mean but that's different than what you want it to be. If I were king for the day, I'd say that was a pretty darn good retail sales report. That suggests very modest real growth because year-over-year retail sales are 8%, inflation is 8%. That says okay. I mean, I'm these aren't apples to apples, but roughly speaking. So I'd say that's exactly what I want. I basically want zero. I don't want consumers to pack it in. I don't want negative because that means recession.
I don't want negative, but I want moderating, right?
Well, that's definitely moderating.
But even core retail sales were strong. I mean, even if you take out food and gas, right?
But
core retail.
But
sales
it's all inflation. Strong. It's all inflation, right? It's real growth is barely positive on retail sales. And that's what you'd want.
But it was a sturdier report than I think people were expecting. But you're saying I don't care what people were expecting.
Well, no. Consensus is what I think what it will be.
Right.
What I'm saying is what it should be if it's good, if it was consistent with my policy goals. It was above consensus, therefore it was above what people expected it will be. But that has nothing to do with what it should be relative to appropriate policy.
I was referring to Fed consensus or Fed expectations of what it should be. Right?
Because
that's what matters, right?
Well,
if the retail sales are coming hotter than the Fed would like.
I'm not sure it is. That's what I'm saying. I'm not sure. If I were on the Fed, I'd say that felt pretty. I felt that felt pretty good to me. That's exactly the report I'd like to see. Okay, let me throw out one other thing. This time is different. And that is credit quality. Yeah, the thing is that credit quality usually erodes pretty substantively when the Fed steps on the brakes and the curve inverts and lenders stop extending credit, and then credit problems start to develop. In that period of time, credit delinquencies, defaults, foreclosures, losses begin to mount, and that adds to the problems that the banking system, financial system face, and therefore they tighten down even more, right? Because they have to react or they're responding to the erosion in credit conditions. Credit conditions now are really good. I mean, really good. I mean, right now delinquencies are going to rise, but they're rising from incredibly low levels, and they may just simply normalize, get back to something that we've typically experienced historically. And of course, the banks. And this time is different. The banks are extraordinarily well capitalized, much more capital than they've ever had, much greater liquidity than they ever had, much better risk management than they've ever had. Of course, the stress testing. And of course, they, we help them out, so that's got to be good, right? So we're not going to have the same kind of credit issues or credit problems that we had. No defaults. I keep going back to the credit spreads in the corporate bond market, BAA Treasury spread. You don't see anything. You don't see any problems. So if that's the case, then maybe lenders don't pull back to the same degree that they have historically.
But they don't need to.
They don't need to. They've got plenty of capital, plenty of liquidity. Credit quality is not a problem. You don't see the restrictions on credit flows. Therefore, the curve inversion means something very different today than it means historically. It's not, you're not going to see the same kind of tightening down of underwriting and credit conditions that you would normally see. What do you,
But we are
what's
seeing
that
on-
explanation?
We talked about this last week, right? And CNI lending is tightening up significantly, right?
It's in
No, that-
recessionary
no,
territory in terms
no.
of the yeah,
No, that-
it is.
No, wait. No, wait. No, it's what you're looking at is a diffusion index
I-
that says directionally I'm tightening, but that has, go look at the actual volume of C&I lending. It's not slowed. It hasn't slowed. C&I
But you
lending,
gotta look
commercial
where the
industrial.
puck is going, not where the puck is.
Well,
today.
I'm just saying that
They're
that's just
tightening, right?
directionally. Yeah, of course they're going to tighten, but it's how much are they going to tighten? I'm just saying. Here, I just gave you a logical kind of framework for thinking about why this time is different. It is different. It is different. It's different from it's very different from a credit perspective, isn't it not? It is.
Yeah,
it is not the
I-
Great Recession. I can
No,
see
no, no. Compared to
financial
any
crisis,
recession,
right?
this is very different from a credit perspective. Mortgage credit, C&I credit, take any kind of credit quality. It's very different than it has been. Underwriting has been very, very good across. I mean, I'm painting with a broad brush, and there's
Yeah.
things out there we need to worry about. Leverage lending, we've talked about.
Personal
And some-
loans are deteriorating fast.
What is?
Personal loans,
Yeah, but
subprime
that-
auto,
See, I find that a red herring too. I mean, come on.
credit card.
Add up cards, add up credit cards, bank cards, retail cards, and all unsecured personal lines. It's $1 trillion outstanding. It's back to where it was pre-pandemic. It's actually tight. There's not been any significant credit. It's actually very incredibly low relative to where you would expect it to be in a more typical time because of the pandemic. I don't know. All I'm saying, you get my drift. You get my drift.
Oh, we
Not
get
Your
it.
drift. It
Yeah,
seems like
yeah.
every data point.
This time
uh,
is different. It is different. Unless you can tell me, and this is what I'm kind of ruminating about, is there some other link between, or a way to connect the dots between the conversion of the curve and the real economy? I mean, I agree with you. It's about credit flows, but is there something else that I'm missing that maybe would have a real economic effect that I'm just not thinking about? Here's the other thing, and this goes to your forecast, Cris, and I know I'm picking on you, Cris. I'm picking on you endlessly, but this is
No.
Marisa, your time is coming. I assure you, your time is coming.
Sure it is. Yeah.
What are your odds, Marisa? By the way,
Yeah,
Just
what
so
are
I know
your
where you-
odds? Yeah, where do you stand on all this?
So I was like at 60% about a
2
week
weeks
ago,
ago.
right? 2 weeks ago, right?
Yeah.
I missed the podcast last week. So I was at 60% probability of recession in the next year. I think I'm now at 2/3.
You went
Oh.
up too?
Yeah.
Why?
after our webinar,
But the CPI number was so good. I mean, why would you go up? I don't understand.
A lot of other economic data has not been good. Yeah, the CPI was good. The PPI was good.
What data are you talking about that wasn't good?
Name it. I mean, pretty much everything that came out this week was not great.
What do you mean?
We'll get to that.
Let's talk about
later.
that. Yeah, I'm really curious about what that means.
I don't want to give away my statistic.
Okay, don't do it.
Name.
Don't do it. Don't do it. Don't do it.
well,
Okay.
housing clearly is going down, right? It's
Well, that's a good thing,
That's-
right? That's appropriate.
okay,
From a
appropriate.
monetary policy perspective, if you're raising interest rates and you want to slow growth, it's got to come out of housing, right?
Yes.
So that's good. Bad news is good news.
No doubt, no
Okay.
doubt. But the likelihood that we can then pivot and stop that wave precisely so that we don't cause a recession seems pretty unlikely to me. But that's the crux of it. right?
No. That's a reasonable argument. I'm just going back. The technical discussion around the yield curve, and
Mhm.
because it's obviously a good point that it's a very prescient indicator. I mean, I think we still need to see confirmation of a hard inversion for more than a couple of days on the policy yield curve, but that may happen because the Fed's going to raise rates.
Yeah,
The funds rate's
in a
going
couple
up, and is
weeks
the
here.
10-year yield going to go up with it? We'll have to see. I'm not sure. So it may invert, but it's just around that technical argument that the curve is inverted. Therefore, I put as you said, I raised my odds because the curve inverted more this week. That's kind of what I'm focused on.
Yep.
Yeah. Okay.
So if the Fed,
Mark-
if we do get that hard inversion for an extended period of time, do your odds change at all?
No. Well, will they change? I don't know. I mean, because I'm not sure. It depends on the economic data and why it inverted. But just because it inverted, what I'm telling you is I'm not sure the curve is. This time is different. It's not the same. It may be implying something, unless there's some causal relationship that I'm missing. There's something going on that I can't quite figure out between the curve and the real economy. But anyway, Marisa, you were going to say something?
Why do you put more weight on the 10-year Fed funds, the policy rate curve, than like the 10-2?
I don't. I
don't?
just think it needs confirmation. I mean, every time you've had a recession, the 2-year, 10-year inverts, but also the policy curve inverts. Now, the policy curve there's false positive. It's inverted and not recession. But every time you've had a recession, the policy curve has inverted. So it's not I'm putting more weight on it. It's just we need that to be confirmation that the 2-year, 10-year is going to be accurate. Here's the other question I had on that, though, because this goes to your kind of forecast. Your thinking is that the recession would hit sometime in I don't want to put words in your mouth, but this is what I recall, first half of next year, kind of sort of by mid-year, we'd have a recession.
Yeah, although I might push that out.
Oh, you would? Okay. Because the curve, if you take a literal interpretation of the curve inversion, it's saying more towards the second half of next year as opposed to the first half or mid-year. But you're saying I'm splitting hairs there.
Yeah, I'm not going to give you the date and time. That's for next podcast.
Okay, all right, very good. All right, well, let's quickly move forward because I want to get on the climate change and the work we've done there. But I guess looking at the economic statistics this week, it's been on the light side, I think, but mostly housing related. Is that right, Cris?
Well, you had retail sales and industrial production.
Oh, that's true. Right.
And we got a lot of the regional Fed manufacturing surveys.
Oh, that's right.
This week too. We got a bunch of them.
Okay,
Philly
well,
Fed
what's
too, right?
Philly Fed? Yeah, Philly Fed. Yeah,
Philly
that
Fed,
improved.
Kansas City,
Philly Fed improved.
Empire
a little bit,
State.
I think. Yeah. Which of all the statistics, Marisa, which would you focus on?
That would be.
Are we going to play the statistics game? No.
Not now. Oh, should I wait?
Well, I mean, the one I'm going to focus on is maybe the one I picked.
Oh, I see. Yeah, that's a good point. Okay. All right, let's wait. We'll wait. Okay. Anything else on the economy you want to bring up before we bring in the rest of the team to talk about climate risk? Anything else you want to bring? Anything bugging you? By the way, I'm getting more confident that the economy is going to navigate through. I am. I'm just getting more confident. I don't know if I'm.
What are your odds now?
45%. 50%. Just 50%.
What?
50%. Okay. But same as last week. But the arrow, for the risk of which way it would change is now lower, not higher. The economic data feels to me definitively like it's moving in the right direction. Beginning with the employment report 2 weeks ago, last week's CPI report, and I'm telling you that retail sales numbers, that was good in my view. No real growth or very little real growth. That's the strike zone. That's what you want. But anyway, that's just me.
Interesting.
Okay. Let's bring in the rest of the team. And we've got 3 colleagues that are going to join. And for listeners, you're familiar with these guys. First up is Gaurav Ganguly. Gaurav, good to see you.
Good to see you too, Mark, Marisa, Cris.
Yeah.
Gaurav.
Did you hear that conversation, Gaurav? Did I change?
I was fascinated by it. I was absolutely fascinated by it. I was hanging on to every word.
He's being sarcastic, isn't he? In a British kind of way. Well, yeah.
I'm sure he wanted to jump right in.
Yeah.
Yeah, I mean, this time is different.
Oh,
Isn't it always?
Oh, I see. How he snuck that in. Jeez, good. It's good to have you, Gaurav. And of course, Gaurav does a tremendous. He leads all our operations in Europe and the Middle East, but also is an expert in climate risk. So it's good to have you aboard. And Cris Lafakis. Cris, good to see you.
Good to see you as well. You gave out a 4-word phrase. So I would give out a 3-word phrase to your 4-word phrase. And
Fire
that
away.
would be
No profanity.
famous last words.
Oh gosh, no one's on my side. Chris, what's the probability of recession in the next through the end of 2023?
Yeah, I think that the 65% range feels about right.
About right to you. Yeah. Okay.
Oh, that's strategic. That
is strategic. Yeah.
1 percentage point under me.
Yeah.
Hmm.
Well,
Nice
you're saying
spike.
66. Are you saying we should change our baseline to a recession? Marisa?
That's what it sounds like.
Well, perhaps.
Okay, you can think about that. Bernard, are you on my side?
I'm
Are you-
definitely on your side. Yeah.
Oh, definitely.
I'm even more optimistic than you. I put it
Oh.
like 40. Yeah, I really think the data has been coming in better than expected, and I think the housing starts. I mean, we can talk about that with the statistics, but I think there's really going to be a glut of, especially on the multifamily side,
Yeah.
which is really going to help bring down rents, and rents is really the crucial ingredient, I think, to our inflation problem. So I
I
don't know.
like this guy.
Yeah.
Yeah, I like this guy. This is Bernard Yaros. Bernard is all things government, federal government. And also, you've been doing a lot of work with the data recently on
Mhm.
economic view. So you've been getting down and dirty with the data,
Yeah.
the U.S. data. So it's good to have you aboard. And the group has worked on a paper. We just released a paper. What's the title of the paper, Chris? The Macroeconomic Consequences of Climate Inaction, I believe. Beautiful
Yeah,
title.
cost.
Oh, and there you go.
Yeah, there it
Chris
is.
is holding that up. The
So Chris killed
macroeconomic-
some trees, but that's okay because I did too.
and you and I and Bernard co-authored that paper, and I thought we'd begin. Oh, we just released it. We're pretty proud of it. So I thought I'd turn to you first, Chris. Maybe you can give us a summary of it, and then I'm going to turn to Gaurav, and he's going to critique it. So he's going to give us his views on what we should have done or not did, or how good it was. We'll get his views. And then Bernard, I'm going to do the same thing with you, and then we'll go into a little bit more detail in some of the numbers. So you want to summarize, Chris?
Yeah, absolutely. So what we did is we were trying to answer the question of what policymakers should do about the issue of climate change, particularly in the U.S. The issue of climate change is global, but the scope of our analysis pertained just to the U.S., and there were some assumptions around that that are documented in the literature. But we ran some simulations. We have this great tool, our global macroeconomic model, that we can use for policy analysis. And to answer the question of in which scenario are we better off in, we ran some simulations that considered different combinations of action and inaction. And so in all together, we ran 4 simulations. The first one would be a current policy scenario, and that's one where there's no new legislation, and actually at the time of us starting on this research, the Inflation Reduction Act, which has a carbon emission mitigation component to it, was not law. So the current policies does not include the Inflation Reduction Act. The second scenario does include the Inflation Reduction Act, so it's the current policy scenario plus the climate implications for the Inflation Reduction Act. The third scenario that we considered was a carbon tax scenario, in which a modest carbon tax is levied. That carbon tax is equal to $40 per metric ton in 2020 dollars. That tax escalates at a rate of the inflation rate plus 5% per annum. And it's capped at the value of the carbon price in our last scenario. Our last scenario considers what would happen, what would be needed to reach net zero carbon emissions by 2050 in the US. And there's a carbon price associated with that. We use the integrated assessment model framework, which is basically looking at abatement curves of various types of pollution and determining the lowest cost alternatives to energy, and what carbon price would be necessary to push the global economy, or in this case, the U.S. economy, to those sources of renewable energy production. And using the carbon prices, that carbon price information, we constructed scenarios. We ran shocks through our model. We have carbon price in our model, so we were able to observe kind of the macroeconomic, fiscal, and climate implications of various combinations of action. At a very high level, that's what we did. If you'd like me to, Mark, I can describe the types of risks that we considered. We considered both acute and physical risk, both chronic and acute physical risk, both industrial transition risk and macroeconomic transition risk, which would be what are the implications of kind of a carbon tax on the macro economy. The transition and risk and physical risk kind of push-pull. So in some of the scenarios where there's maximum physical risk, there's less transition risk and vice versa. And lastly, what I would say is that our conclusion is that in the very long term, it's more expensive to do nothing than to do something. So in the short run, if you don't act, you can achieve some better economic outcomes. But if we're looking at 2100 and beyond, the cost of inaction outweighs actually the cost of action.
Yeah. Okay. So just to summarize your summary, so just to make it concrete, we ran these 4 different scenarios under different policy assumptions to see what kind of impact that would have on the economy. And we used our global model, but we were focused on the U.S. economy. And when we talk about the economic consequences, really broadly speaking, 3. As you said, acute physical risk. So that's the cost of hurricanes and flooding and of fire, that kind of thing. The second is chronic physical risk, and that would be things like sea level rise, heat stress, and it reflects the impacts that has on sectors of the economy like tourism or agriculture, that kind of thing, which is very obviously dependent on weather. And then the third is economic effect that we considered was the transition cost. So because of the change in policy, carbon tax or the IRA, the Inflation Reduction Act, it imposes some costs on the economy in that transition, and we account for those going forward. And the bottom line is that interestingly enough, under every scenario, and we simulated the impact on the economy out through 2100, so a long period of time. Obviously, a lot of assumptions that go into this. But what we find is in all scenarios, the economy, and we measured the economy by real GDP, is actually lower than, if there was no climate change. Okay, big deal. That's pretty obvious. But the conclusion is the sooner you take action, the lower the cost to the economy, the less of a hit to GDP in the future. And then the third basic result was of all the policy efforts, steps that we considered, carbon tax seemed to be, particularly one that's phased in slowly over time, is the most efficient way, the optimal way of doing this. It results in the least amount of lost GDP economic damage out there in the forecast. Is that roughly right? Did I get that right?
That's it.
Okay.
You got it.
All right. Okay. Now, there are a lot of assumptions and that go into this. Do you want to just quickly enumerate the 2, 3, 4 key assumptions that, there's a lot, but the 2, 3, 4 key assumptions that went into the analysis?
Sure. I mean, I think that the main one is that, we give credit to policymakers for mitigating physical risk in these action scenarios. So we calculate chronic physical risk, we calculate acute physical risk under all of the 4 assumptions. And based on the amount of emissions reduction of the policy action, we reduce the hit to macroeconomic activity from chronic and acute physical risk. And so we do that the most in the net zero 2050 scenario. We don't do that in the current policies scenario. The biggest assumption is that we assume that all of the various countries decarbonize at the same rate as the United States. And that's clearly a very big assumption and probably not how the world works in practice.
Well, that's not how the world's going to be in practice, but that's a working assumption here. Yeah,
that's right. So if we have a net zero 2050 scenario that we considered is predicated on the emissions reductions predicated on all of those countries reducing emissions, adopting net zero 2050 as well, and that's not going to happen. But we made that as a simplifying assumption because it's very hard if you don't make any assumptions like that. How much credit should you give U.S. policymakers for mitigating chronic physical risk? And that's the first one. And then the second one is that we assume that policymakers will provide as much aid for natural disasters as they have historically. So we looked at all of the extreme weather events in the United States dating back to Hurricane Hugo, and we said, okay, all of the major ones, all right, what was the economic loss according to NOAA? What was the federal appropriation? What percentage of the economic loss was the federal appropriation? When you do that, you get around 46%. There's also some state aid and so on and so forth. So 46%. And so when we were disaggregating acute physical risk, what we first had to do was determine how big is the hole, and then how is it going to burden the various sectors of the economy. And the sectors of the economy that would be affected by acute physical risk include the public sector through the provision of aid, consumers if they're not insured and they lose property or they lose rental avenues, businesses if it's the same version of the consumer argument, just on the other side of the foot, and then the insurance sector, because they have to raise premiums, but they also have to make these large payments. And that's one key piece of acute physical risk, is that over time, I mean, if Hurricane Harvey hits, maybe insurance premiums will go up a little bit, but if Hurricane Harvey hits 3 years in a row, there's going to be a lot of insurers that are going to walk away from that market entirely. And the ones that don't will significantly raise the cost of insurance, and that gets cascaded down through the entire economy. So we assumed that the federal government spends a lot of money dealing with the fallout of natural catastrophes, particularly in the the current policy scenario that includes maximum physical risk. We also calibrated to the NGFS estimates the expected value. There's a range of losses, and there's a chart in the piece that you can see the range of
NGFS being the network for greening the financial system that's doing a lot of work in this area. So we did use some of the information and data that they have provided.
That's correct, and they have a distribution of losses according to chronic physical risk, because we really haven't seen this movie before. We can tell you what's going to happen if there's a tax cut, but when in terms of projecting out to 2100 and accounting for physical risk, we have models, but there's a larger amount of uncertainty there. And so we took the expected value, so the midpoint of this distribution there, for our own analysis. The estimates for loss according to chronic physical risk under the current policy scenario are more severe if you take something like the 90th percentile or the 95th percentile losses. And then lastly, what I would say is that we assumed that 60% approximately of the revenue collected by the federal government under the taxes in the two tax scenarios, that the net zero 2050 and the carbon tax scenario, are returned to consumers in the form of a dividend payment. And there's obviously different ways that lawmakers could go about, kind of like mitigating the damage done by their policy to certain income groups or certain regions in the United States that they probably would need to do in practice if they were implementing, even a modest carbon tax. But that's the percentage that we assumed, because we wanted it to be revenue neutral, and we didn't want to crowd out private investment in the very long term. That's actually what happens in the current policy scenario, is that the outlays, the federal outlays get so large and the loss in revenue is so disruptive that debt rises substantially, and interest rates rise as a consequence of private investment getting crowded out. And so that's another feature of that fiscal dynamic is a feature of our current policy scenario.
Got it. Well, I'll just mention one other, and then I'm going to bring Gaurav into the conversation. A border adjustment, right? I mean, because you want to mention that very quickly?
Yeah,
That's a
the
key
CBAM,
assumption. Yeah.
the carbon border adjustment mechanism is something that is becoming mainstream, and I think that it's going to be very, very almost nearly impossible for any country to pass any meaningful carbon price or carbon tax legislation that does not include a carbon border adjustment mechanism, because the outcry from industry, you're essentially, if you don't include a CBAM, you're making your domestic industry non-competitive, or you reduce their competitiveness relative to the international competitors. So what that means is, with the border adjustment, is that if you are a producer of fossil fuels in the United States, you get taxed when you extract those fossil fuels. You have to pass along the tax if you're to your downstream, or if you're exporting the tax, and if you do pass along the tax, that leads into inflation eventually for the macroeconomy. But if you export the fossil fuels that you extract, you get a rebate for the tax, and the same thing applies to further downstream.
Got it. Yeah, and of course there's a lot of other assumptions, but those are the kind of the top 3-5. Gaurav, you weren't specifically working on this research, but you do a lot of research in the climate risk area. And what's your sense of this as a kind of a neutral observer? I mean, anything here that struck you as interesting or stands out or even surprising?
So let me start by saying, and okay, this is clearly a biased comment from me, but I think it's a great paper. It's really well laid
Now,
out.
is that British
It reads
sarcasm?
simply.
Did you hear British
this is the
sarcasm
real
there?
thing. This was the
This
real
that
thing.
was a real thing. Okay,
This is the real
I'm
thing.
trying to
Yeah.
get my ears not quite used to the. Okay, go ahead.
No. It's totally the real thing.
That's the real thing.
This is a great paper. It's really well laid out. It's really easy to read. There's so many assumptions that go into making climate scenarios that it's really easy, to not see the forest for the trees. But I think some really good messages come out of this paper, and I like reading it a lot. So some things that I liked, and some things that I think, are avenues. Not really. There are lots of. It's really difficult to model climate change and model the economic consequences of climate change, as Cris Lafakis knows all too well. So it's not really about what's wrong with this paper as what's, where do we need to go from here to make pieces of research like this more complete, I think is the best way I can put this. So a few observations from me on what I've taken away from this paper. First of all, it's great to see some real world analysis and see some comparison of what's actually happening in countries like, and take the US and the Inflation Reduction Act, which is a big piece of legislation and which is a big step forward for the US. If you compare it to the EU, which has its climate action plan, and the European Green Deal, that's been years in the making, and it's been passed into legislation, and the EU has been moving along for some time now on this path. And it's great to see the US embarking on the Inflation Reduction Act, and it's great to see a piece of work that actually highlights the impact of the Inflation Reduction Act. So I like that very much. I also like to see the comparison to a simple, conceptually elegant economic tool called carbon tax. That's not the way the world works. The world is not implementing a simple, conceptual, elegant tool like a carbon tax. The world is actually doing a whole bunch of different things. And the IRA shows you that actually the US is taking a very different path to a carbon tax. The EU, which does actually have a emissions scheme, it doesn't tax carbon, but it has a cap and trade scheme. I mean, these two are theoretically at least interchangeable. But even there are a whole bunch of other measures in place where the EU has phased out laws. Internal combustion engines are going to be phased out by 2035. So there are lots of different schemes in place. It's really good to see a piece of work that actually uses a carbon tax. And it's a great way to show how you can actually decarbonize an economy using a very simple conceptual lever. The other great thing about using the carbon tax is that there's a big criticism that's usually levied against carbon taxes, which is that a carbon tax is regressive, i.e. it hits the poor harder. But you guys have shown how you can get around that problem by having a dividend payment. This is not an insurmountable challenge to using a carbon tax. Okay. Using a carbon tax is not, it's brought out in the paper again, but I'll make the point. Communicating over a period of time. This is really quite important to have well-telegraphed policy that's communicated over a fairly lengthy period of time in order to decarbonize an economy. Decarbonizing an economy can't really work effectively in a jerky way. It's not going to happen overnight. It's a long process. It needs policy that's well thought through, well telegraphed, and goes out over a period of time, and that commitment stays most importantly. And finally, I suppose the other point about the carbon tax is that it shows the way in which decarbonization works. I mean, implicit behind this assumption that you start with a low carbon tax and then ramp it up over time is the idea that actually the cost of abatement varies depending on which sector of the economy you target. There are some sectors of the economy that are easier to decarbonize and hence require a lower carbon tax, and other sectors of the economy that are incredibly hard to decarbonize and ultimately will require a much higher carbon tax if that is to happen. Take steel and cement, for example. Cross-border adjustments, the CBAM, really important piece again, I think, shows you that the world can't, shows you some of the difficulties of implementing a carbon tax. I really don't see countries just coming together and implementing globally implementing carbon taxes in the individual countries in the way that it all works, and a border carbon adjustment is not required. I just don't see that happening. So any country that wants to effectively decarbonize has to introduce some kind of border carbon adjustment, not just for the reasons that, I mean, it's not just about the future transition that Cris mentioned, that if a country imposes a carbon tax, then that sort of creates a negative cost for domestic industry. It's also the fact that countries with current account deficits are currently importing carbon. China is the world's biggest emitter, but it actually exports its carbon emissions to countries like the US that import a lot from China. So putting in a carbon tax right now means that current imports from China would be subject to a carbon tax. And that would be the right thing to do in order to decarbonize consumption in the US, because emissions per capita on a consumption basis in the US are far higher than emissions per capita on a production basis. So a carbon border adjustment is something quite important. Downsides of a carbon tax and what's not in this piece of research, that again, this is hard one. So this is again, I repeat, it's not a criticism of the research. Carbon taxes
You can
can't
do
apply
that
to
too.
every sector of the
Criticisms are
economy.
okay. I'm really good
Well,
at doling out criticism.
it just
Feel
can't be,
free.
because nobody's got an answer to this.
Okay, fair enough.
Carbon taxes don't apply to every sector of the economy. And I'll mention a few where
Yeah,
it's
good
really
point.
difficult to apply a carbon tax. It's things like agriculture, livestock, deforestation, waste management, poor land use. It's very difficult to actually measure emissions from these sectors and these areas of the economy. And so it's very hard to monitor and effectively put a carbon tax on them. And they usually require alternative policies. So if you want to have a scenario of effective decarbonization, carbon tax will always need to be supplemented. You'll also need to supplement a carbon tax with alternative policies, because there are implementation frictions. The paper assumes that implementation challenges overcome in real life. That's probably not going to be the case. There will be a lot of frictions. So finding the appropriate mix of policies that help implementation to be overcome will be important. And that's, again, I think, a future piece of research. There was one interesting thing that I found, and I don't know what you guys think about this, but I was looking at the Inflation Reduction Act and the net zero carbon tax on chart 10. So I'm just advising everyone listening to this to go and read the paper and look at chart 10.
You can Google
chart
it,
10,
right? Zandy.
what's that?
You can Google
Yeah,
it. It says
you can
Zandy,
Google
the
it.
macro costs of climate inaction. Yep, you can get to it. Yep.
And when you get through the paper and you get to chart 10, you'll see the difference in US real GDP. And I'm looking at it now, policy scenario versus no climate change scenarios. And you've got all the different policy scenarios out there. And you show the Inflation Reduction Act, the carbon tax scenario, and the net zero carbon tax. And what I see from there is that in the Inflation Reduction Act, there's very little transition risk. And in the net zero carbon tax, there's much more transition risk. But in the Inflation Reduction Act, there is correspondingly much more physical risk, and in the net zero carbon tax correspondingly much less physical risk. So what that tells me from my sort of naive reading of it is that the IRA scenario, the IRA policy is actually minimizing the costs to the current economy, putting a lot of cost on the future. So it's intergenerationally quite inequitable. We're simply putting a lot of cost on future generations to bear because physical risks will be felt much later in the century and will be borne much more by later generations. Whereas a net zero carbon tax, actually telegraphing policy now, being committed to it and getting out to net zero by 2050 feels on an intergenerational basis the right thing to do. We are not going to leave the burden of climate change to our sons and daughters and their children to bear. It's something we're going to take on now and deal with now. And that I found to be quite an interesting, that was for me what I took from that chart. That this is not enough. This is simply pushing the problem, continuing to push the problem out to future generations. So those were a few thoughts from me.
Very, very good. And I'm going to bring Bernard in just a second on the Inflation Reduction Act, because that's what he spent a good amount of time on. And Bernard, maybe you can react to what Gaurav said in addition to everything else you want to talk about. But I have this kind of very simple way of thinking about climate risk, and it makes me feel better about things and makes me sleep at night easier. And that is, the solution to climate risk is pretty simple. I mean, from an economic perspective, just tax the carbon, put a price on it. I mean, yeah, there's all kinds of, complications like the border adjustment and the dividend and so forth and so on. But, you put a price on something, good things happen. People use less of it. That means less carbon. People figure out ways to new technologies and innovation to get around it, to use less of it. So, and we've got a lot of experience with that. Like go back to the fossil fuel industry. You go back, I can remember 2008, I think it was July 3rd, 2008. I'm making that up, but I'm within a day. Oil prices hit their all-time high. And everybody, Goldman Sachs on down, was saying peak oil, we're running out of oil, $250, at that time it was $130, $40 a barrel. We're going to $250. That's where we're headed. And because prices were so high and the energy companies could make so much money, they invested and they came up with fracking. And fracking changed the whole landscape, very significantly. And, it just goes to the point that, if you put a price on something, if people can make money on something, they figure it out. So, I understand all the political issues with taxing carbon. It's very difficult to do politically. But at the end of the day, when push comes to shove, if we have to solve climate change, you just price it. Is that just too simple a way of thinking things, Gaurav?
No, I completely agree with you.
Good, okay.
The best way to make an economy work effectively is to let prices prices work their magic. Prices have information. Prices send a signal. They motivate people to do things.
Yeah. Okay. All right. And this is the big difference between the carbon tax scenarios and the IRA. The other simple way of looking at it is the carbon tax is a stick. I'm gonna hit you over the head if you use carbon, and therefore you're going to use less carbon. The IRA, and of course you can understand the political problems with that. When you start hitting people over the head, they get pretty upset and they say, I don't want to do that. And by the way, I'm going to vote for the other guy and I'm going to give them money so that you can't do that. And, so forth and so on. So the IRA ingeniously, I think, although when you think about it for a second, maybe pretty straightforward, it's all about carrots. Is that right? Incent people to do things by giving them tax credits and government spending, that kind of thing. Is that fair, Bernard?
That is entirely correct. It's largely all about carrots. If I were to split the IRA into three components, you've got tax credits, you've got about $270 billion in tax credits, which largely, are trying to incentivize the production of clean energy, the investment in renewable energy projects, and then also trying to address climate change through other avenues like carbon sequestration, clean fuels, and also clean energy manufacturing, very much in the spirit of like the CHIPS Act. And then there's also, a lot of carrots extended to households and businesses for investing in energy efficiency at home and, in commercial structures. And also, a lot of clean vehicle tax incentives as well. So it's really the tax credits that really do the heavy lifting. You also have a direct spending by the government, but to a lesser extent, that's closer to about $120 billion over the next decade. And this is, a large chunk of this is really reducing emissions from agriculture and forestry. There's a lot of grants, loans, and rebates, and it taps into the procurement might of the federal government to really promote, the adoption of clean energy, and also incentivizing a lot of energy efficiency improvements in residential and industrial structures. It addresses air pollution. There's a lot of investment also in climate resilience, which isn't emissions reductions, but it really helps the economy, especially in coastal communities and regions that are prone to droughts. To weather the ravages of acute and chronic physical risk going forward. When it comes to the sticks, it's a very minor share of all this. There's about $20 billion over the next 10 years that you could consider to be pay-fors or revenue raisers. So most notably, you've got the Superfund tax on that they're going to be imposing on crude oil and imported petroleum, and the revenue here is obviously going to be used to defray the cost of cleaning up hazardous waste sites. There's also going to be a methane emissions reduction programs, which would be a fee on excess methane emissions from the oil and gas industry. So that's really targeting, methane leaks that really plague the natural gas output. So it's the vast majority of this is really carrots, and only a very tiny portion of this are sticks. I think there's again, I don't think this is the most efficient way of addressing climate change as the carbon tax, as we've been discussing, but there's still a lot to like in the way these programs are set up. So I'll start first with the tax credits. I mean, because that's really the main impetus of this legislation. The duration is very important. So these clean energy tax credits are really in place for a decade or more, in some cases to close decades, to 2 decades, and that's very important for clean energy developers and investors who in recent times they've been facing nonstop lapses and just last minute extensions of clean energy tax incentives. And then there's just a lot more flexibility in these tax in these tax credits than before. So in the federal tax code, it's the two tax credits that are really do the heavy lifting in terms of incentivizing clean energy production is, the investment tax credit, which is just an upfront credit against the investment cost of a clean energy product. And then there's the production tax credit, which is a credit for every kilowatt hour of energy that's produced by renewables. And one really good point here is that the solar energy previously was only eligible for the investment tax credit, but now it's going to be eligible also for the production tax credit. And this matters because as the cost of solar declines, that's going to make the investment tax credit less valuable versus the production tax credit. And then I think the last piece, this has gotten a lot of also good feedback generally from what I've seen, is just it makes it much easier to monetize these all these tax credits, because remember, because the production and the investment tax credits have generally been non-refundable. And if you want to benefit from a non-refundable tax credit, you have to have a tax liability. And that's something that tax-exempt entities like public power agencies, local governments, rural electric cooperatives, nonprofits, they don't have. So the IRA makes these, essentially refundable for tax-exempt entities, and it also allows makes these tax credits for others who aren't tax exempt transferable. So that means that developers can transfer their credits to a third party in exchange for cash. And this is important because under the current system, there's a lot of tax equity financing where you've got an investor that provides capital in exchange, an investor that provides capital for a clean energy project in exchange for the right to claim, these green energy tax credits and depreciation deductions. And the IRA, I don't think it's going to do away with that, but it's going to provide other alternatives to tax equity financing, which has high transaction costs that can be very prohibitive especially for smaller scale developers, and especially for developers of more cutting edge clean energy technology. So those are some of the things that I really like.
Yeah.
There's others, but there's still, again, there's a lot of risks and assumptions that we're making, as we discussed in the paper. Obviously, we've been talking ad nauseum over the past couple of years about labor supply constraints and global supply chain disruptions. Those are obviously concerns that could also constrain the amount of emissions reductions that we're assuming. But I would
guess the
say that
domestic content rules too, right? Another issue. Yeah.
Exactly. But I would say the biggest risk in our IRA scenario, in which we're being a bit too over optimistic, would be that we don't get enough, we don't expand transmission lines across the United States as fast or faster than the historical average. So decarbonizing the U.S. economy to the extent that we're expecting or we're modeling under the IRA really involves extending the existing grid that we have to areas where you've got abundant sun, wind, and other renewables that can then be transported to where they need to go through transmission lines. But these transmission lines, they're going to inevitably cut through state lines. And just the process of securing property, land rights, permitting, just planning and siting these interstate electricity transmission lines is just a very difficult task. You have to contend with the whole array of state authorities, also grassroots opposition. And one of the other outside sources that really helped us informed our analysis, the Repeat Project, they're from Princeton. They recently did another scenario where they were looking at a scenario in which transmission expansion does not occur or occurs as slowly as it has historically. And they're basically saying is that the emissions reductions could be anywhere as much as 80% or 25% lower than what they had previously, than what they would forecast in a scenario where there's no constraints at all in transmission. So, this is a big risk. Fortunately, there's the bipartisan infrastructure law addressed this. They proposed some reforms. And the IRA also does provides some grants to accelerate the siting and permitting projects of transmissions. But I think that's really the big risk when I'm looking at our IRA scenario.
That's very comprehensive. Can I just I want to go to the game quickly before we do that. Do you want to respond to Gaurav's point about intergenerational effects, that this kind of pushes the pain off into the future? I'm not sure I get that, but how do you react to that?
Yeah, I see the I see the point from the perspective of acute and physical risk. We are benefiting the economy of today to the detriment of, I think, future generations. But I still think.
Can you explain that, guys? I can't quite get my mind around that. Why is that the case?
Because there's less transition risk today. There's less of a financial cost.
Oh, I see.
I see. But I was really thinking about a lot of this really from the fiscal perspective, because there are significant, even under the Inflation Reduction Act, there are still, we still benefit future generations from a reduced federal debt burden. And historically, I look a lot at the federal, the federal government outlook. Every 6 months, we get a report from the congressional budget offices that's warning about, the long-term sustainability of the budget. And historically, we're always worrying about aging population, about the rising cost of Medicare and of medical care, and then just issues with long run potential growth. But I think we really should add to that list of worries for the federal budget, climate changes. I think that's another thing that I think our paper really showed. You really by reducing a lot of the economic losses and the burden on the government, you really have significant reductions in the debt to GDP ratio over the long term. And that, that does benefit future generations, and it does help mitigate the worst of, the worst fiscal effects. And for, the Congressional Budget Office, they do incorporate, from what I've seen, they do incorporate climate change, but they're really looking only out through 2050. And what we're really showing is that it's really in the back half of this century where the fiscal costs in tandem with the environmental costs really rise significantly.
Yeah, very good. I think that was a very comprehensive review of that paper. So hopefully listeners will take a look and find it of some value. Okay, we're going to go to the game before we call it quits. And Marisa has been biting at the bit here. Is it biting at the bit? Is that the right word?
Chomping
at,
at
I knew chomping at the bit. Well, biting sounds okay too, actually. Biting at the bit, chomping at the bit with her statistics. So, and of course, the game is each of us put forward a statistic, and I'm not sure we're going to all of us have time to do that, but we put a statistic forward. The rest of us try to figure it out with clues and questions, deductive reasoning, and the best statistic is one that's not so easy that we all get it so fast, but one that's so hard we never get it. But and bonus if it's relevant to the topic at hand. But fire away, Marisa.
Okay, it's not relevant to the topic at hand. I'll just put that out there right now. Minus 0.8% in October.
And this was a statistic that came out this week.
Correct.
Is it in the retail sales report?
No.
Okay. Is it in the industrial production report?
No.
Is it one of the Fed regional Fed reports? Okay.
Is it in the PPI report?
No, that didn't come out this week.
Did it?
Or it did come out.
It
did.
Yeah, I thought it did.
No.
Yeah,
Was
it
that
came out
last week?
Tuesday. CPI was last week. Yeah.
It was favorable.
Bernard knows. He
It
forecasted.
was favorable.
Was it this week,
That's
Bernard,
right.
or was it last week?
It was this week.
Oh yeah, it was. It
This
was
week. This week. That's all a
Monday or
blur.
Tuesday.
It's all
yeah.
I think it was Tuesday. I think. Okay. Well, this is getting tough. Is it housing related?
Is this something Bernard should know?
Because Bernard's tracking all the real-time economic data.
As an economist, Bernard should know. Sure.
Oh, okay. It's not one of
We
the
all
things he's
should know.
tracking.
Can you give us a hint?
So you asked me what one of my favorite, when we were talking about the probability of recession and indicators, and you asked me what one of my favorite ones to look at. This is one of my favorite ones to look at. It is surrounding the conversation about the yield curve and how predictive it is about recessions. This one is also quite predictive of recessions.
Minus 0.8.
Is it the Empire State Manufacturing Index?
No.
Yeah.
God, I thought you guys would get this.
Really?
Right off the
okay.
bat. Yeah.
Wow. Minus 0.8.
It's Conference Board leading indicators.
Yes, it is.
Very good.
It came out this morning. It came out actually.
Right. That's
before
why
we
I haven't had a
started
chance to
talking.
look.
Yeah,
I haven't had a chance to
came
look.
out at a little after 10.
And this is the leading indicators.
That's correct. That's right. So this is the Conference Board's leading economic indicator index. It is pretty good at predicting recession over a 6 to 9 month period. The decline in October was the 8th consecutive decline over the month. And it was the largest decline that we've seen in 1 month, abstracting from the pandemic. So if I take out March and April 2020, it was the largest decline we've seen since March of 2009, which was the last month of the Great Recession. It's pretty dour. It is well into recessionary signaling territory, like well below it.
I'm guessing that what's driving that? The stock market, permits for housing, for sure.
Yeah, housing is in there. The S&P
Yield curve.
500 is
Yield
in
curve
there.
is
The
in
yield
there.
curve is in there. The Michigan Consumer Confidence Survey is in there. And
UI
these things, as we
claims.
know, have all been bad. UI claims are great. So, but yeah, that's in there.
Deteriorating, right?
Are they?
Bit.
That's
Okay.
deteriorating. Is
Yeah, that's true. They're not helping lift.
They're not
the-
helping. Right?
Yeah, they're not helping lift the Elliott.
They're
Is
still
anything,
incredibly low.
or can I ask it this way? I think I'm speaking from memory, 8 different indicators that
I
are
think there's
included.
10.
10. Okay,
Yeah.
10.
There's 10 different
Of
indicators.
the 10, are there any that showed any kind of positive in the month?
That's a good question. I didn't look at each individual indicator,
Okay.
but if I look
Yeah.
at, I mean, there's new
Because that's the one I
orders.
want to focus on. Just saying.
The 1 out of the 10 that showed positive. Yeah.
Exactly. That's the one that's the most important
bright
one. That
side.
one.
Oh, there were 3 that increased.
Oh, okay. What were they, Chris?
Largest possible interest rate spread,
Okay.
manufacturers' new orders for non-defense capital goods,
Okay. Those are 2. Yeah.
and manufacturers' new orders for consumer goods.
Oh, okay. Those seem like low on the list of. Yeah.
In terms of importance. right?
Yeah. Importance. Yeah. Too bad. Okay. All right. That was good though. We should have gotten. Although it was this morning. That was the issue. I've been on Zoom
Yeah.
all
I
morning.
snuck in and
Yeah, you
grabbed
snuck it
that.
in.
right
Nice,
before
nicely
the-
done. Nice.
Yes,
Nicely
thank you.
done. Nicely.
Stealthy.
Very, very tricky. All right. Let's. Who wants to go next? Gaurav, you want to go next? Do you have a statistic you want to throw out?
Yeah,
there?
I can come up with a statistic. It's
All
not a
right.
conventional economic indicator, but it is linked to the paper we just discussed.
Okay. Fire away.
And the number is 52. That's not the meaning of
52.
life, because that's 42. Okay.
Yes. Yeah. That's where my mind went.
That's exactly. Yeah, that's what I was thinking.
No, the meaning of life, the universe, and everything, as we all know, is 42. My number is 52.
52.
Number that came out this week.
It didn't come out this week. It came
Oh.
out in, I'd guess, the last month or so.
And it's climate.
And it's a number
climate
that you wouldn't
related.
find very easily. I've got to confess. You've got to read a fairly dense report to get to this number,
It's
Is
climate
it a
related.
number of countries?
and it's climate related.
Go ahead, Chris.
Is it a number of countries?
No,
Not the number of countries that did something.
it's specifically related to a very important concept in that climate paper.
Carbon
The one that you have to carbon, yes, carbon.
So
but not
some
the
kind of
tax.
there's some kind of physical. It's physical related, right? So something
Right,
in the physical
right.
environment.
Correct.
If you get above 52 degrees C, you got a real problem or something.
No,
Your
but
body
you're right.
breaks
You're right.
down.
It's related to the physical environment, but it's not.
Yeah.
It's not temperature.
What was that? What's that called? You know what I'm talking
The
about?
wet bulb. Yeah,
The wet- yeah,
The
the
one
wet
we talked
bulb.
about this about wet
bulb. And
wet
what's
bulb
that? What's that temperature? Do you know? Is that
Oh,
temperature?
Yeah, there's a gosh.
I think it's
that
52
number escapes me.
degrees C. I'm just
35?
saying.
No, wet bulb. Is it wet bulb 35? No, it's not 52C, and that's not the probability of recession. At least not my probability of recession. All right. Shall I just?
Yeah,
I
fire
just
away.
No,
Yeah,
you
go
can-
for it.
So
Push
it's
out of our
it's
misery.
it's the median estimate of gigatons of CO2 equivalent for all greenhouse gases emissions by 2030, right? So that's the number, 52
Okay.
gigatons of CO2 in that emissions in 2030, if all signatories to the Paris Accord implement all their pledges. That's where we'll get to.
Cumulatively.
And in 2030,
Oh,
the annual
annual.
emissions will be 52
wow.
gigatons of CO2
Okay.
equivalent for all greenhouse gases if all signatories to the Paris Accord implement all their pledges. In 2019, that number was about 54 and a half. So
Wow.
if all pledges are actually put into effect, then we will bend the emissions curve by 2030 as a world.
Oh, goodness, that sounds like a lot of gigatons.
That's a lot of gigatons. We will blow through.
Even if we do what we probably won't do, it's still a lot of gigatons.
It's still a lot of gigatons, and it basically tells us that we'll still blow through 1.5 degrees, which is the ambition of the Paris Accord.
That's 1.5 increase
centigrade.
above its pre-industrial era, and that's kind
Correct.
of the bogey here. But it feels like we're going to blow right through that.
We're going to blow through that.
Yeah.
Unfortunately. In fact, and I think in our baseline forecast for the U.S. Or global, we're assuming 2.5 degrees C, aren't we?
Yeah, we're
And
around
that, by the
2.5.
way, is exactly what the UN comes up with its emissions gap report, which is, by the way, this very dense report from where I picked out this fantastic statistic. So the UN gap report for 2022, and it's a great report which they compile every year, look at all these NDCs, and they lay out how much they think temperatures could go up by if various things get done. And the median estimate for global warming by 2100 is 2.5 degrees.
Yeah. Okay. Okay. So we're right in the right down the strike zone here. Yeah. Okay. Let's do one more because this is getting pretty long in the tooth, and let's go to Bernard in honor of his because he's recently taken on more responsibility at Economic View and is really focused on the real-time statistics. And as you could tell from
Which
his,
is why he is the only one so far who's gotten the statistic.
yeah, I know, and you can tell from his description of the Inflation Reduction Act, he is very detail oriented, which is really a good thing. But fire away, Bernard.
So it's negative 4,000.
Negative 4,000. Is it a statistic that came out this week?
Yep.
Related
Is
to
it climate related?
risk?
No.
No.
Is that the decline in initial UI claims?
Yep.
Yep.
From week to
Ding,
week?
ding, ding. Yeah.
Oh, okay. Now that is pretty impressive. Gaurav, what would you say? No sarcasm.
I'm speechless. I'm speechless, Mark.
Cecil. Chris
Overhanded
Lafakis, what do you
softball right
think?
there.
Everyone, come on.
Yeah,
God, come on.
I was thinking UI claims before you said it. So,
Oh,
yeah,
how rude.
I'm just
Yeah.
more reserved.
It's more reserved. Yeah. More, I think the word is humble. Is humble. I am anything but humble, given the opportunity. All right.
The reason
well,
why I brought this up is
Yeah.
because we've been getting a lot of questions about all the steady drumbeat in the news about tech layoffs. So there's just been nonstop from Meta, Amazon, all the turmoil in Twitter right now. So there's been, I think some people have been incorrectly saying, oh, all of these tech layoffs are an impending sign of doom or recession. But I would really push back, and especially people are also saying like, what's going to happen to jobless claims? Because by our count, there's been about close to 40,000 job cuts in tech just this month, as of yesterday. And obviously, if all of those show up in jobless claims, that's going to really push us jobless claims close to the break even, which would be breaking level of which would be close to zero or lower growth in jobs. But I think a lot of these, if you look at the information sector right now, job openings are very high. They're off their peaks, but they're still very high. So I would assume a lot of these people are really going to find, jobs pretty quickly. Also, a lot of these folks are also going to be getting 3 months or so severance pay. So that's also going to be enough of a financial backstop to, bridge them over, until they find a new job. So I don't really see this as, tech is not really an area of the labor market that I would look for signs about a forthcoming recession. It's always, I think temporary help is a much better indicator of labor demand. So.
well, and I should say you are doing a lot of writing now on the daily indicators, and you wrote this up in your release yesterday.
Yeah,
and,
yesterday. Yeah, exactly.
Yeah, and it's really well done. Kudos. I mean, really,
Okay.
I enjoy reading it, which is, I don't enjoy reading much, but I really enjoy reading that. So that was very, very good. Okay, I think we're going to call it quits. Are you okay with that, Chris Lafakis and Dorides? Did you notice Chris was drinking Wawa coffee?
I noticed that.
He
A
wants
very
to be like
large one as well.
a very large one, and this is not. I think he wants to be more associated with the everyday man, because giving
He's
those
offsetting
glasses
the
and
glasses.
yeah, and the lattes he drinks, a little sippy thing he has, or
Is it
do you have
hazelnut latte?
I just like coffee,
Okay.
in all its forms.
Okay, very good. Very good. Well, thanks everyone for spending an hour and a half with us. That was, I thought was very informative, and we'll talk to you next week. Take care now.